You heard it here first. U.S. investors are fleeing America. No, not because they hate the country, but because they hate outsized risk, and money hates concentration risk.
In the last 6 months alone, roughly $75 billion flowed out of U.S. equity products as global markets outpaced the U.S. and investors chase returns elsewhere.
So imagine waking up free from tying your entire portfolio to one volatile political system, one crowded stock market, and one fragile currency, while your money works in markets that are stronger, cheaper, and growing faster. That's what we're building towards. And today we're giving you a glimpse of how we got here. We're going to dive deeper into this. And if you want to dive deeper, stay tuned to see how we help people just like you reach those retirement goals.
This is Queer Money episode number 631, brought to you by the Optimize Portugal Golden Opportunities Fund. More on that later. And today we're tackling a hot button trend that's gone from meme to mainstream. Investors aren't just diversifying globally, they're de-USifying their portfolios.
As a matter of fact, there's a name for this. It's called the Abusa trade, or anything but the USA.
Before we dive deeper, let us know in the comments if you're diversifying your life or your investments in any way, shape, or form out of the US. Give us a green heart and share what you're doing.
All right, so the first thing we're going to talk about here is that this shift is real. Capital is rotating. Money is moving. Markets historically have focused on the U.S. and the U.S. trade. Money from all over the world has been poured into the United States, especially over the last 20 to 25 years. But that market dominance of the U.S. right now is being challenged by some of the money moves that are actually happening. As John mentioned in the outset, $75 billion over 6 months, or roughly $12 to $13 billion a month, has been pulled out of U.S. markets or U.S. stocks. And these individuals are moving their money to other places. They're doing this specifically by investing in emerging and developed markets. Now, they may be doing this by keeping the money here in the United States and investing in ETFs that are emerging or developed market. They also may be moving their money outside of the U.S. for these investments.
Yeah, and you can verify this yourself by doing some research of what major indices in Europe and Asia are doing. For example, Japan's Nikkei is up 43%, probably a little bit more at this point. South Korea's Kospi is practically doubled. They've outpaced U.S. markets despite the U.S. dollar being weaker relative to their currency. And that should make foreign equities more expensive, but people are still rotating out anyway because they see political and concentration risk with the U.S. So this is what we call capital in motion, and that momentum seems to be picking up.
It's not just U.S. investors that are doing this. There are actually foreign investors who had poured money into the U.S. are now pulling that money back, maybe repatriating it to their own country or their own region of the world.
So we're going to dive more into that. So let's talk a little bit about why exactly investors are shifting away from the US. Basically, it's because of international outperformance. This isn't just a headline story. This is actually about the hard numbers. And 2025 isn't proving to be a one-off scenario. However, international equities did outpace US markets in 2025. The MSCI World X USA climbed roughly 33%, while the US S&P 500 climbed about 16 to 17%. So while yes, we can say that the US stock market is great, and under normal conditions, a 17% return would be wonderful. If you look across the seas, you could get markets that are almost pushing 33, and even some cases in Ireland, for example, well beyond 33%.
Yeah. So experts are saying that despite the strong returns from the tech side of the US market in 2025, international equity performance still was stronger than the US markets in 2025. And there has been a lot of talk about how 2025 was a lot of that was driven by this overweight in AI performance or AI trade, companies that are connected to AI. So there's great returns coming from those companies, but the rest of the market in the US wasn't performing as well. And even all of that combined did not perform better than these international markets.
Right. And one of the risks that investors are seeing is that we've talked a lot about there being this AI bubble, and artificial intelligence has not necessarily produced its own return on investments quite yet. We're hoping that someday happens, but to a lot of people, that sounds a lot like 1999 and the dot-com bubble. And then, of course, we've talked a little bit too about this sort of circular economy in that everybody's investing in NVIDIA, including corporations. And so in order to buy NVIDIA products, you're investing in NVIDIA, and it's just kind of creating this circular economy where everybody's sort of this little micro ecosystem. And if there's any disruption in that ecosystem, what's going to happen to the overall stock market, including the overall US economy?
Right. All right, the third thing we're going to be talking about here is policy and geopolitics and how these are having damaging effect on your portfolio, basically kicking your portfolio. Portfolio risk isn't just what's going on in the macro economy, so the United States or globally, it's also political. The US dollar has been a dominant currency for a long time, but we're now seeing that dominance shrink. Its share of the global currency reserves around the world is actually starting to decline, especially compared to what it has been for the recent few decades. And central banks are basically getting rid of U.S. treasuries. They are deliberately diversifying their reserves away from the U.S.
Yeah, European governments and institutions, Indian, Chinese, they're all reducing their U.S. treasury holdings. And that's the kind of news that doesn't necessarily make the headlines, but it has a significant impact on the U.S. economy and eventually the U.S. stock market. And these are hedges against geopolitical and financial instability that these countries, these investment organizations and firms are seeing that they need to reduce their risk in the United States. Now, Barron's reports that the dollar index declined about 8% over the past year amid reserve diversification and reduced foreign central bank demand for U.S. debt. People are starting to say, or other countries, I should say, other organizations outside of the U.S. are starting to say, the U.S. has too much debt, and the games that we're playing over here don't necessarily indicate stability, so we're going to reduce our risk. That just doesn't make the headlines. This is what we call strategic de-dollarization, and that's going to have a long-term effect on the U.S. economy and the U.S. stock market eventually.
Right. And I think that we look at what has been said by this administration, some of the things the administration has said has triggered individuals in other countries, I think specifically of Canada and in Europe, has triggered them to say, I'm not going to buy U.S. products. I'm not going to buy U.S. whiskey. I'm not going to buy a variety of other products from the United States. Well, when they are buying those products, their countries don't need to convert their currency into dollars to make those purchases. They're either keeping that money at home or they're sending it to other countries. And this is another thing that can be driving down the value of the dollar. And the reason why this is really important for us to think about is as the value of the dollar drops, one, if you're living overseas, things that you're purchasing in US dollars are going to get more expensive. Two, for individuals living here in the United States, when the value of the dollar drops and the US Treasury's securities drop, interest rates go up. And this is one of the reasons why I think the whole economy has been struggling to be able to bring interest rates down, especially on mortgages and credit cards.
So why does diversification matter? It matters beyond just the percentages. It matters about lifestyle. So here are three reasons for why we're diversifying away from the United States. The first is reduced concentration risk. A portfolio heavy in U.S. stocks, bonds, and dollars is too correlated to U.S. political economic outcomes and pervasive U.S. uncertainty. That could all be summed up by one word: Trump.
Yeah. The second thing is that there are different growth engines, right? The emerging markets and developing markets have distinct drivers in their economies. So think about labor demographics and how they're different in, say, for example, in many Asian countries where the age demographic is much lower than it is, say, for example, in the United States. There's also different manufacturing cycles that happen outside of the U.S. And so those can be some drivers for growth. There's also commodity demand. We've heard the term rare earth, right, a lot, and that is related to actually extracting minerals and processing those minerals in various countries, and some countries have easier access to those. So all of this is giving potentially these emerging or developing markets outsized performance because those things are not necessarily happening in our country.
Yeah, and third, and maybe as important as anything, is currency and spending alignment. If you plan to retire abroad or you are retired abroad, where you spend your money matters, as David alluded to earlier. If you're living outside of the United States and you're buying products and services in US dollars, cost of living has just gone up exponentially. So aligning your assets with future money outflows in local currency, as we're doing in Mexico with the peso and eventually in Europe with the euro, smooths out that currency risk. This isn't about abandoning America. It's really about protecting your future.
Right. The fifth and final facet that we're going to be talking about here is the fact that U.S. markets still matter, but not exclusively, not as much as they used to. Yes, the U.S. still does produce a lot of innovation and provides a lot of liquidity. Think about NVIDIA and other huge tech giants and what they've been able to do recently over the last few years. There's been a lot of change, but despite all of that change and that innovation, money is still flowing outside of the U.S. And in this environment, it is pretty risky risky. If you're going to retain 100% of your retirement portfolio exposed to exclusively the US, it's like putting all of your eggs in one basket, but that basket, as we know right now, is very politically linked.
Yeah, so just contrary to Trump's rhetoric, leadership for retirement portfolios shifts when there's continued policy uncertainty and that uncertainty continues to rise. There's geopolitical risks and that continues to increase, and future growth prospects soften domestically. Essentially, investors are going to adapt to do what they need to do to have the success that they want to have.
All right, so we said that we are doing some of this diversification ourselves. So we wanted to share with you exactly what we're doing. We're acting and we're not just talking. So several months ago, we sold a significant portion of our U.S. securities, especially individual stocks. And then a couple of weeks ago, we did that again to basically bring a bunch of our money into cash because of the volatility. But we need to decide, what do we want to do with that cash? We don't want it just sitting there. So we decided that we were going to invest it in foreign markets, especially being in a foreign market, allowing us to be in a foreign currency and not susceptible to the ups and downs of the dollar. And we specifically chose Portugal with the current sponsor of the Queer Money podcast, the Optimize Investment Partners Portugal Golden Opportunities Fund. Now, we didn't just invest in this because they are the sponsor of the podcast. Here are a couple of reasons why we've invested in this fund. Year to date, this fund is up 6.5%, whereas the S&P 500 at the time of this recording is not even up 0.25%.
But the Dow, David, the Dow.
Right, exactly. But the Dow. But for us, is giving us some opportunities, right? We are being more mobile with the money that we have. We're opening ourselves up to a possible Mediterranean lifestyle. This is all a life that is optimized for what we want and what we want our future to be. So if you want more information on the Optimize Fund, you can go ahead and tap the link in the description of this video or in your podcast player, whichever you're consuming this content on. But we also wanted to share with you that we're not just doing this blindly. We have done our research. We have found that this fund is a SEC registered fund, which is very rare for mutual funds outside of the US to be registered with the SEC so that they can attract US investors. The other thing we like about this fund is it has a ticker symbol that is US based, and we can watch that fund and see the performance of it on a daily basis. And finally, this fund has received a number of Morningstar rewards. Morningstar is one of the top rating agencies for mutual funds and ETFs, and they give out rewards based on performance and how the fund is being managed to its specific goals. And we really like that idea that it's being rated by a US firm that looks at mutual funds all around the world.
Yeah, so this is an active, adaptive diversification strategy which all investors should be doing through retirement and beyond. That said, this is not a recommendation for everybody. Make sure you do your homework, research the fund yourself, and maybe talk to your financial advisor to make sure that it fits your portfolio. It fits us, so we're just sharing what we're doing so you have that information to make better decisions for yourself. Okay, so let's recap. Investors are reallocating globally, as are we. International markets outpaced the US in 2025 in real total returns, and it looks like that's going to happen again in 2026. Dollar dominance is weakening and central banks are diversifying, which is raising considerable concern for us personally. And diversification isn't anti-American. We don't hate America. We just hate concentration risk.
Right, and political risk. So if your portfolio plan is still buy US and hold forever, you're flying blind when it comes to today's global economy. The world is multipolar, and so should your portfolio be. So again, if you are diversifying your investments or your life outside of the US, give us a green heart in the comments and share with us what you're doing exactly. And if you're not sure how to diversify out of the US or want a second, third, or fourth pair of eyes to review your retirement plan, click the link in the description below or on your podcast player to see how we can help you specifically.
If you're a Gen Xer, make sure you subscribe to Queer Money on YouTube. We're working on a piece about why retirement planning is harder for our generation. Sorry, millennials. And what Gen Xers can do about it. If you like this episode, as always, please remember to like, subscribe, click all the bells and whistles, and definitely share Queer Money with your friends and family who want to retire fabulously, retire abroad, or just retire. And until next time, stay fabulous. Finally, if you want to learn more about how we're investing in Portugal specifically, check out this interview with Optimize Investment Partners CEO, Pedro Lino.